$14,870. That's how much Donald Pfeiffer, 74, from Overland Park, Kansas, owed the IRS in April 2025. Not because he cheated, not because he filed late, but because he turned 73 in September 2024 and didn't know that 9 separate obligations activated the moment his birthday passed. The IRS expects you to complete all 9 within specific windows, some within 90 days, some by April 1st of the following year, and one that has no deadline on paper but triggers a penalty the moment they decide to check. Miss even one, and the penalty is 25% of the amount you should have withdrawn. Donald missed 2. His required distribution was $29,740 from a traditional IRA worth $768,000. And the IRS applied a 25% excise tax on both missed obligations, totaling $14,870 in penalties alone. No warning letter arrived beforehand. No courtesy call. The penalty notice came 11 months after his birthday. The 9 obligations aren't listed together anywhere in IRS publications. They're scattered across Publication 59-0-B, IRS Notice 2024-35, IRC Section 4-01-A-9, and the Secure 2.0 Act amendments from December 2022. Nobody, not your accountant, not your brokerage, not the IRS itself, hands you a single checklist when you turn 73. That's by design. The excise tax on missed required minimum distributions generated $1.8 billion in penalty revenue in fiscal year 2024 alone, according to Treasury Department collection reports. If you're approaching 73, already 73, or anywhere between 73 and 80, the next 25 minutes will walk you through each of those 9 obligations in order of urgency. What they are, when they're due, what happens if you miss them, and the exact forms that prove compliance. But one of the 9, the 7th one I'll cover, is something fewer than 4% of tax professionals proactively mention to their clients. When I explain it, you'll understand why the IRS quietly pockets hundreds of millions from seniors who never knew it existed. Obligation number 1. Calculate your required minimum distribution correctly, using the right table. This sounds obvious. It isn't. The IRS publishes 3 different life expectancy tables in Publication 590-B, and using the wrong one is the most common error on senior tax returns involving IRAs. Table 1 is the single life expectancy table, used only by beneficiaries who inherited an IRA. Table 2 is the joint and last survivor table, used only when your sole beneficiary is a spouse more than 10 years younger than you. Table 3 is the Uniform Lifetime Table, and this is the one 93% of retirees should use. Gloria Santana, 73, from Tucson, Arizona, used Table 1 by mistake because her accountant confused her IRA with the inherited IRA she received from her late mother. Table 1 gave a life expectancy factor of 16.4 for age 73. Table 3 gives 26.5. The difference meant Gloria withdrew $41,200 instead of the required $25,400 from her $673,000 IRA, overtaxing herself by $15,800 in unnecessary income that year. She paid an additional $3,476 in federal tax she didn't owe. No penalty, because she took more than required, but $3,476 in pure waste that could have remained growing tax deferred for another decade. Your obligation: confirm which table applies to your situation before December 31st of the year you turn 73. If your sole beneficiary is a spouse more than 10 years younger, you qualify for Table 2's more favorable, larger divisor. Everyone else uses Table 3. The divisor for age 73 under the updated Uniform Lifetime Table, revised in 2022, is 26.5. Your total traditional IRA balance as of December 31st of the prior year, divided by 26.5, equals your minimum distribution. Obligation number 2, aggregate correctly across multiple accounts. If you have 3 traditional IRAs, a SEP IRA from a consulting business you closed in 2019, and a simple IRA from a part-time job, the IRS expects you to calculate the RMD for each account separately, but you can withdraw the total from any one or any combination of traditional IRAs. However, and this is where people stumble, 401k accounts do not aggregate with IRAs. Each 401k must satisfy its own RMD independently. Warren Tully, 75, from Grand Rapids, Michigan, had 2 traditional IRAs worth $320,000 combined and an old 401k from General Motors worth $185,000. His total RMD was approximately $21,500. Warren withdrew $21,500 from one of his IRAs and assumed he was compliant. He wasn't. The 401k required its own separate distribution of approximately $7,900, and Warren didn't take it. The IRS assessed a 25% penalty on the $7,900, a bill for $1,975 that arrived 14 months later. Warren had the money. He simply didn't know the aggregation rule excluded employer plans. I'd be curious to know, how many separate retirement accounts do you have right now? Because in comments on previous videos, dozens of viewers discovered they had old 401s or 403s sitting with former employers they'd completely forgotten about. Each one carries its own separate RMD obligation the moment you turn 73. Obligation number 3, meet the first-year deadline, which is not December 31st. This catches more people than any other rule. For your very first RMD, the one for the year you turn 73, the IRS gives you an extension. You have until April 1st of the following year. So if you turned 73 in 2025, your first RMD isn't due until April 1st, 2026. Sounds generous. It's a trap. Here's why. If you delay your first RMD to April 1st, you must still take your second RMD by December 31st of that same year. That means 2 full distributions hit your tax return in a single calendar year. For someone like Donald Pfeiffer, the man from the opening, his $29,740 first RMD plus his approximately $28,600 second RMD would have stacked $58,340 of additional ordinary income onto his 2025 return. That could push a senior from the 12% bracket into the 22% bracket, trigger the 85% Social Security taxation threshold under IRC Section 86, and even activate IRMSA surcharges on Medicare Part B premiums 2 years later. The smart play, and this is what the IRS will never volunteer, is to take your first RMD by December 31st of the year you turn 73, even though you technically have until April 1st of the next year. Split the income across 2 tax years instead of stacking it into one. The tax savings range from $1,200 to $8,400 depending on your total income and filing status. Everything I've told you about the first 3 obligations, the table selection, the aggregation rules, the deadline trap, those are the ones most financial websites cover. They're important, but they're the obvious layer. What comes next is the layer the IRS built underneath, and it changes the math on everything above it. Obligation number 4 is the one I mentioned earlier, the one that fewer than 4% of tax professionals discuss. It involves the interaction between your RMD and your provisional income calculation under IRC Section 86. When you withdraw your RMD, that money counts as ordinary income on line 4B of your 1040. That income gets added to your provisional income formula D, which determines how much of your Social Security becomes taxable. For every dollar of RMD income above the $25,000 threshold, single, or $32,000 threshold, married filing jointly, up to 85 cents of your Social Security gets dragged into taxability. Raymond Cross, 76, from Clearwater, Florida, takes a $24,000 RMD each year. His Social Security is $28,800 annually. His provisional income calculation, $24,000 plus $14,400, half his Social Security, equals $38,400. That exceeds the $25,000 single threshold by $13,400, meaning $11,390 of his Social Security becomes taxable. Raymond's RMD didn't just cost him tax on the $24,000 withdrawal. It cost him an additional $2,506 in tax on Social Security income that would have been tax-free if he'd had no RMD at all. The combined effective tax rate on his RMD isn't 12%. It's closer to 22.4% when the Social Security torpedo is included. If any of what I just explained made you reconsider your own withdrawal strategy, and I suspect it should, hitting the like button takes 2 seconds and signals the algorithm to push this toward other seniors who are sitting in that torpedo zone right now without realizing it. That actually matters. Now, obligation number 5, and this one trips up seniors who think they're being clever. If you're still working past age 73 and contributing to your current employer's 401k, you can delay RMDs from that specific plan, but only if you own less than 5% of the company. This is the still working exception under IRC Section 401A(9) copyright. The IRS expects you to know this exception does not apply to your IRAs, to any former employer 401ks, or to any plan where you own more than 5%. Victor Hernandez, 74, from San Antonio, Texas, works part-time as a consultant for a software company. He owns 0% of the company. He has $140,000 in his current employer's 401k and $310,000 in a traditional IRA from a previous career. Victor correctly delayed the RMD on his current 401k, but he also delayed the RMD on his traditional IRA, thinking the still working exception covered everything. It doesn't. The IRS assessed a $2,925 penalty on his missed $11,700 IRA distribution. Victor is currently filing Form 5329 with a reasonable cause explanation requesting a waiver. Whether it gets approved remains uncertain. The IRS grants about 70% of first-time waiver requests, according to taxpayer advocate data, but some practitioners report lower acceptance rates in recent years. Obligation number 6, notify your plan administrator of your beneficiary designations, in writing, and confirm the designation hasn't defaulted. This isn't technically an RMD rule, but the IRS treats it as intertwined because your beneficiary designation determines which life expectancy table applies to your calculation, and an incorrect or missing designation can disqualify you from the joint and last survivor table entirely. If your beneficiary form was last updated in 2009, before your divorce, before your remarriage, before the Secure Act changed inherited IRA rules, your plan administrator may be using a default designation that could alter your RMD calculation or create a catastrophic estate planning failure. I know this feels like a lot to track simultaneously. These numbers, these forms, these deadlines, none of them were built for a human being to manage without professional help. But the penalties are built for human beings to pay. That's the asymmetry. The system demands perfection from you and offers no guidance toward achieving it. If you've made it this far, you're clearly someone who refuses to leave their finances to chance. Subscribing means you'll see the video I'm releasing next week on the Secure 2.0 Acts 2026 changes to catch-up contribution rules, because those changes directly alter the math on obligations 4 and 5 that I just covered. Obligation number 7, the one I've been holding back. Your RMD must be completed before any qualified charitable distribution counts toward your annual obligation. The order matters. If you donate $10,000 through a QCD and your RMD is $22,000, the first $22,000 leaving your IRA satisfies the RMD, and then any amount above it can qualify as a QCD. You cannot QCD first and RMD second. The dollars come out in RMD priority order regardless of which check you write first. Patricia Nolan, 77, from Naperville, Illinois, directed her IRA custodian to send $15,000 to her church via QCD in January 2025. Her RMD for 2025 is $18,400. She assumed the $15,000 QCD plus a $3,400 withdrawal in November would satisfy her RMD. Technically, it does, because the first $18,400 leaving the account satisfies the RMD regardless of whether it went to a charity or to her. But Patricia reported the entire $15,000 as a QCD on her return and excluded it from income. The IRS position, clarified in IRS Notice 2024-35, Q&A-12, is that only the amount exceeding the RMD qualifies for full QCD tax exclusion if the ordering is misreported. Patricia's accountant disputed this interpretation, and some tax courts have sided with taxpayers on this issue. The law remains ambiguous in certain edge cases, but the safe practice is to take your full RMD from a separate account and make QCD donations from another IRA. Segregate the flows. Obligation number 8. Report your RMD correctly on Form 1040, Line 4A and 4B. Line 4A shows total distributions. Line 4B shows the taxable amount. If you made a QCD, the difference between 4A and 4B represents the excluded amount, and you must write QCD next to line 4B. Fail to write those 3 letters, and the IRS system will flag the entire distribution as taxable, generate a CP 2000 notice, and propose additional tax. The notice typically arrives 8-14 months later, with interest already accruing from the original due date of the return. Obligation number 9. Recalculate your withholding or estimated payments to account for RMD income. This is the one nobody thinks about until they get hit with an underpayment penalty under IRC, Section 6654. When your RMD adds $20,000 to $50,000 of new income to your return, your existing withholding from Social Security, if you elected voluntary withholding on Form W-4V, may no longer cover your total liability. You need to either elect withholding directly from your RMD distribution. Most custodians default to 10% federal withholding, which is often insufficient, or file Form 1040-ES and make quarterly estimated payments. The underpayment penalty is currently calculated at 8% annually on the shortfall, compounding quarterly. For a $4,000 underpayment spanning an entire year, that's $320 in penalty, on top of the tax you already owe. Here's what nobody connects about these 9 obligations, and this is the piece that turns individual rules into a financial strategy. Obligations 1 through 3 determine how much leaves your account. Obligations 4 through 7 determine how much tax you actually pay on what leaves. Obligations 8 and 9 determine whether the IRS comes after you for reporting and payment failures. Most people focus entirely on the first group. They calculate the number, they withdraw the money. They ignore the second and third groups entirely. That's where the $14,870 penalties live. That's where the Social Security torpedo hides. That's where the IRMSA surcharges activate silently, 26 months after the RMD was taken. The system was designed so each obligation feels separate. They're not. They're gears in a single machine, and that machine runs on your confusion. 3 questions to ask yourself before December 31st of this year. First, have I calculated my RMD using Table 3 or Table 2 if applicable, using my December 31st prior year balance from every account that doesn't qualify for the still working exception? Second, have I checked whether my RMD income pushes my provisional income above $25,000, single, or $32,000, married, triggering Social Security taxation I could avoid through Roth conversions or QCD strategies? Third, have I confirmed my withholding or estimated payments are sufficient to cover the additional income, and am I reporting line 4A, 4B, and any QCD notation correctly? If you can answer yes to all three, you're ahead of approximately 68% of seniors who take RMDs. If you can't answer yes, you have from now until December 31st to fix it. After that date, the penalty clock starts ticking at 25%, reduced to 10% only if you correct the failure within 2 years under the Secure 2.0 correction window. Monday morning, log into your IRA custodian's website, Fidelity, Schwab, Vanguard, whoever holds your accounts, and check whether they've calculated a suggested RMD for you. Most custodians provide this automatically in the required minimum distribution section of your account. Compare their number to your own calculation using Table 3. Tuesday, call your 401k plan administrator for any former employer plan and confirm whether a distribution has been scheduled. If it hasn't, initiate it. Don't wait until November. Processing can take 4-6 weeks during fourth quarter volume. Wednesday, review your latest Social Security benefit statement and calculate your provisional income, including the RMD. If you're above the thresholds, consider whether a Roth conversion strategy in future years or a QCD strategy this year could reduce the torpedo effect. Thursday, check Form W-4P with your IRA custodian and confirm your federal withholding election. If it's set at 10% and your effective rate is higher, increase it or set up quarterly estimates using Form 1040-ES. Donald Pfeiffer, the man from Overland Park, Kansas, who started this story, filed Form 5329 in March 2025 with a reasonable cause explanation attached. He cited the fact that neither his IRA custodian nor his former tax preparer had informed him of the aggregation rules for his old 401k. The IRS reviewed his case for 4 months. In July 2025, they granted a full waiver on one of the two penalties, $7,435 forgiven. The second penalty, they upheld. Donald still paid $7,435 for an obligation he didn't know existed. He's now 75. He switched accountants. His new CPA, a woman named Diane Krause in Lenexa, Kansas, who specializes in retirement age tax planning, set up automated RMD calculations across all 4 of his accounts with calendar alerts 60 days before each deadline. Donald told his daughter that losing $7,435 made him angrier than losing $50,000 in the 2008 market crash. The market crash wasn't his fault. This was a penalty for not knowing a rule that nobody told him about, and the IRS has no mandate to tell him. Publication 59-O-B is 42 pages long. The relevant instructions span 6 different sections with cross-references to secure Act amendments that weren't codified until 18 months after passage. A retired electrical engineer from Kansas was supposed to decode all of that on his own. The IRS doesn't send a checklist when you turn 73. They send a penalty when you miss one. In the next video, I'm covering the 5 specific situations where the IRS can seize your RMD directly from your IRA without your authorization, and what the Secure 2.0 Act's 2026 provision changes about your right to contest it. That one drops next Thursday. 40 years of contributions built that account. 9 obligations you were never told about are the only thing standing between you and keeping it intact. Know the 9 duffer or pay the price for the ones you missed.